Chinese company listed on the NASDAQ, I should say. They just received a delisting notice, right, Susan?
So the CEO has stepped down, and now the NASDAQ says it's time to delist.
Today's story is one of the most unbelievable financial scandals to ever hit Wall Street. A story about coffee, lies, and the dark side of corporate ambition. We're talking about the Luckin Coffee scandal, a case that shook American investors and revealed how even the brightest business dreams can turn into billion-dollar nightmares. Now picture this. It's 2017. In China, a new coffee brand appears almost out of nowhere, Luckin Coffee. They promise to revolutionize coffee culture. No long lines, no waiting, just order from an app and grab your drink. The concept was simple but brilliant. Within just 2 years, Luckin Coffee had opened more stores in China than Starbucks. The numbers were insane. They were growing faster than anyone thought possible. Investors called it the Chinese Starbucks. American investors couldn't resist. When Luckin went public on the NASDAQ in May 2019, it raised over $561 million. Wall Street was in love. Analysts said it was one of the most promising IPOs of the decade. Big funds, institutions, and even individual American investors jumped in. Everyone wanted a piece of the action. After all, how could a fast-growing tech-driven coffee company in the world's largest market go wrong? Well, it did. Behind the glossy branding, the modern stores, and the clean marketing campaigns, a lie was brewing. Luckin Coffee wasn't selling as much coffee as it claimed. It wasn't growing at record speed. It was faking its success, one cup at a time. In early 2020, it all started to fall apart. Whispers began to circulate about something strange in Luckin's financial reports. A mysterious short seller report accused the company of fabricating sales data. The report was detailed, with evidence collected by investigators who literally sat outside stores and counted customers. What they found was shocking. The sales Luckin claimed to be making simply didn't exist. Soon it was revealed that Luckin's chief operating officer, Jian Liu, and several employees had fabricated more than $310 million in revenue during 2019. That's right, hundreds of millions of dollars that never existed. Fake receipts, fake transactions, fake sales, all created to make the company look like it was growing faster than it actually was. Imagine being an investor sitting in New York, checking your portfolio and seeing your shares of Luckin Coffee skyrocket. You're proud, you found the next Starbucks. Then, just a few months later, the truth comes out and your investment collapses. In a single day, the stock price dropped by more than 75%. Billions of dollars vanished. It was financial devastation. The scandal exposed a deep issue in the world of global finance: trust. American investors trusted the company because it was listed on the NASDAQ. They assumed that meant transparency, regulation, and accountability. But in reality, the auditing process had failed. The company's books were full of lies. The U.S. Securities and Exchange Commission launched an investigation, and by the end of 2020, Luckin Coffee agreed to pay a $180 million fine to settle fraud charges. The company was delisted from the NASDAQ, and its reputation was destroyed. For many Americans, this was a brutal lesson. Just because a company is listed on Wall Street doesn't mean it plays by Wall Street's rules. And let's not forget the human side. Many small investors, ordinary people saving for their future, lost everything. People who had seen Luckin Coffee as an opportunity to grow their retirement accounts or make some quick profit ended up burned. There were stories of families who lost their savings, young traders who felt betrayed, and institutional investors who quietly swallowed massive losses to avoid embarrassment. The scandal also created political tension. U.S. lawmakers began questioning whether Chinese companies should even be allowed to list on American exchanges without stricter oversight. They argued that foreign companies using American money must follow the same transparency standards. Luckin Coffee became the symbol of a larger issue: the lack of financial accountability across borders. But how did Luckin pull it off for so long? Inside the company, there was an intense culture of pressure. Executives wanted to show rapid growth at any cost. Managers were pushed to deliver impossible numbers. When real sales couldn't meet the targets, they started inventing them. Fake transactions were created using fake customer accounts. The company even manipulated marketing budgets to make fake sales look real. To the outside world, Luckin looked unstoppable. The media loved the story. A young, modern, digital Chinese brand challenging Starbucks on its own turf. But the truth was darker. The company was burning cash, and its so-called success was just a massive illusion. When the truth broke in April 2020, the reaction was immediate and brutal. The stock market went into panic mode. Shareholders rushed to sell. Analysts called it China's Enron. Within weeks, top executives resigned or were fired, and several were charged with fraud. The company's market value collapsed from $12 billion to almost nothing. And it's not just the investors who were affected. Employees inside the company were caught in the chaos too. Some unaware of the massive fraud happening above their heads, suddenly facing layoffs, public scrutiny, and legal investigations. Customers, who thought they were buying from a successful, trustworthy brand, unknowingly became part of the story of deceit. The scandal also sparked endless debates online and in financial news circles, with experts asking, how could such an audacious scheme go unnoticed for so long? This moment really shows how far-reaching the effects of corporate fraud can be, touching not just the stock market, but lives and trust across the globe. Today, Luckin Coffee still exists, but the story has changed. After the scandal, the company restructured, settled charges with U.S. regulators, and rebuilt its business. In a surprising comeback, Luckin expanded internationally and even opened its first U.S. locations in New York in mid-2025, marking a new chapter in its growth strategy. Investor.luckincoffee.com+1. That said, Luckin's presence in the U.S. is very different from what it once was as a NASDAQ-listed darling. The company was delisted from the NASDAQ after the accounting fraud was exposed in 2020, and while it has recovered operationally, it is no longer listed on the major U.S. exchange. A sobering reminder that a business can return to the marketplace physically without restoring the same investor trust it once had. For American investors and consumers, the lesson remains clear. A storefront or an app in your city does not erase the history of loss, investigation, and regulatory penalties. Many investors were hurt when the fraud came to light, and the SEC settlement and delisting left permanent marks on trust in cross-border listings and corporate governance. If anything, Luckin's U.S. openings are a reminder that companies can pivot and reopen markets. But history and investor caution stay with them.